Listen, I need everyone to sit down for this one, because what I am about to tell you is the kind of information that separates the people who build real wealth from the people who spend their entire lives wondering why they never got ahead. In my 40 years in banking, managing portfolios worth billions at firms like JP Morgan, I have watched the same pattern repeat itself over and over again. When panic hits the streets, when headlines are screaming about trade wars, about geopolitical conflict, about market meltdowns, that is precisely when the wealthiest families on earth go shopping. Not later, not when things feel safe again, right now, during the chaos. And I'm going to show you two stocks today, two professional grade selections that smart investors are accumulating while the rest of the market is running for the exits. But first, I need you to do something for me. Subscribe to Invest with Marcus right now. Hit the notification bell. Why? Because every single video on this channel is designed to give you the same institutional quality analysis that I used to deliver in boardrooms to some of the wealthiest people on the planet. This is not entertainment. This is your financial future. Subscribe now and drop a comment telling me which stock you think is the better buy after you watch this video. Let us build this community together. Now let me set the stage, because context is everything when you are making investment decisions. At the major firms like JP Morgan, we never bought a single share of anything without first understanding the macro environment. Right now, we are living through one of the most complex economic landscapes I have seen in 4 decades. We have got the Federal Reserve trying to thread the needle on interest rates while inflation remains stubbornly persistent. We have an escalating geopolitical crisis in the Middle East, with the Strait of Hormuz effectively closed after military operations in late February, disrupting global commodity flows and sending energy prices surging. We have trade tensions rattling supply chains worldwide. And underneath all of that chaos, we have two massive structural trends that are not going away, regardless of who sits in the White House or what happens in any single quarter. Those two trends are the explosion of artificial intelligence across every industry on Earth, and the fundamental reality that the world still needs to eat, which means agriculture and the commodities that feed it remain non-negotiable. These are not speculative themes. These are the operating realities of the global economy. And the two stocks I am about to walk you through sit right at the heart of each one. Let us start with the first name, Scala, ticker symbol ZS. Now, before your eyes glaze over because you think cybersecurity is boring, let me reframe this for you the way a portfolio manager thinks about it. Cybersecurity is not a technology trend. Cybersecurity is infrastructure. It is as essential to the modern economy as the electrical grid was to the Industrial Revolution. Every company, every government agency, every hospital, every bank on this planet needs cybersecurity the way your body needs oxygen. It is non-discretionary spending. When budgets get tight, companies cut marketing. They cut travel. They cut perks. They do not cut cybersecurity because one breach can destroy everything. The global cybersecurity market is projected to grow from roughly $228 billion in 2025 to over $350 billion by 2030. And within that massive market, the zero-trust security segment alone is expected to nearly double from about $42 billion to almost $90 billion in the same time frame. That is your addressable opportunity right there. So why Scala specifically? Because this company is not just another cybersecurity vendor selling you antivirus software. Scala built the largest inline security cloud on the planet. They process over 500 billion transactions every single day through what they call their Zero Trust Exchange. More than 45% of the Fortune 500 trust Scala with their security. Think about that for a second. Nearly half of the biggest, most sophisticated, most risk-averse corporations in America have already chosen this platform. That installed base is a goldmine because once a company integrates Scala into its infrastructure, the switching costs are enormous. Nobody wants to rip out their entire security architecture. And every time that customer adds more users, more applications, more cloud workloads, more AI agents, Scalar's revenue grows without them having to make a single new sale. That is what we call a compounding business model, and it is exactly the kind of economic engine that built generational wealth for my clients at the institutional level. Now let me walk you through the numbers, because this is where it gets really compelling. Scala just reported its second quarter fiscal 2026 results, and the execution was outstanding. Revenue came in at $815.8 million, up 26% year-over-year. Annual recurring revenue hit $3.36 billion, growing 25%. Net new ARR was $156 million for the quarter, up 19%, with particular strength in large deals. The Americas region closed twice the number of million-dollar-plus deals compared to the same quarter last year. Free cash flow margin hit 36%, and when you combine that with the 26% revenue growth, you get what is known as Rule of 62 performance. For those of you who are not familiar, any company that can add its growth rate to its profit margin and get above 40 is considered elite. Scala is performing at 62. That puts them in rarefied air, alongside the very best software companies in the world. The balance sheet is rock solid with $3.5 billion in cash and short-term investments. And remaining performance obligations, which represent committed future revenue, hit $6.1 billion, growing 31% year-over-year. That backlog gives you incredible visibility into the growth trajectory ahead. Here is where it gets even more interesting for 2026 and beyond. Scala is positioning itself as what they call the cybersecurity platform for the AI age. As artificial intelligence agents proliferate across enterprises, each one of those agents needs to be secured. Each one represents a potential attack surface, and Scala's zero-trust architecture is uniquely designed for this because it enables direct one-to-one communication while minimizing lateral movement across networks. They recently acquired companies like Red Canary for managed detection, SPLX, and SquareX for browser security, expanding their platform capabilities aggressively. Management raised their full-year ARR guidance to 24% growth, targeting roughly $3.75 billion in annual recurring revenue. The consensus analyst price target sits around $267 to $330, depending on which estimates you reference, with some analysts projecting as high as $385. The stock is currently trading near $150, which means Wall Street sees anywhere from 75 to over 150% upside from current levels. Now, I have to give you the straight talk because that is what I do. Scala faces real competitive pressure from Palo Alto Networks, CrowdStrike, and other players who are consolidating their security offerings. The company cut its fiscal 2026 revenue guidance slightly after its earnings report, and the stock has been punished severely, dropping from over $330 at its 52-week high down to the $150 range. That is a more than 55% decline. And yes, the elevated valuation metrics on a forward PE basis might make some investors uncomfortable. But here is what I learned managing money for decades. When a company is growing revenue at 26%, expanding margins, generating massive free cash flow, has $3.5 billion in cash, carries $6.1 billion in committed backlog, and is trusted by nearly half the Fortune 500, a significant price decline is not a red flag. It is an invitation. The institutional investors I worked alongside for 40 years, they did not buy stocks when charts looked pretty. They bought when the fundamentals diverged from the price action. And right now, Scala's fundamentals are diverging from its stock price in a way that I find very, very attractive for long-term investors. Now let us shift gears completely and talk about a very different kind of opportunity. The Mosaic Company, ticker symbol MOS. If Scala is the digital fortress protecting the future economy, Mosaic is the foundation feeding it. This is one of the largest phosphate and potash producers on the planet. They operate phosphate rock mines in the United States, potash mines in Canada, and run a massive fertilizer distribution operation in Brazil through their Mosaic Fertilizantes segment. In a world where 8 billion people need to eat every single day, the companies that produce the crop nutrients that make modern agriculture possible are not optional. They are essential. And right now, the geopolitical situation has turned this already important company into something potentially explosive. Let me paint the picture. In late February 2026, military operations led to the effective closure of the Strait of Hormuz. For those who are not familiar, the Strait of Hormuz is one of the most critical choke points in global trade. A massive amount of the world's fertilizer, energy, and raw material shipments flow through that narrow waterway. When it closes, supply gets disrupted on a massive scale. Fertilizer prices have already surged. Shares of fertilizer producers like CF Industries, Nutrien, and Mosaic have jumped 10 to 30% since the conflict began. But here is the thing. This is not just a short-term trade. The structural dynamics underneath Mosaic's business are improving on multiple fronts simultaneously. Let me walk you through the fundamentals. Mosaic reported Q4 2025 revenue of approximately $3 billion, which actually exceeded analyst forecasts by about 8.7%. Now, the earnings per share of 22 cents missed the 44-cent estimate, and that spooked some investors. But you have to look deeper than the headline number. The miss was largely driven by a massive $960 million working capital headwind that crushed cash flow in 2025 and pushed net debt up by $829 million. That sounds terrible on the surface, but management is guiding for a significant working capital release in 2026, which should dramatically improve the cash flow picture. They achieved $150 million in cost savings in 2025, ahead of schedule, and they are targeting an additional $100 million in 2026. Phosphate production is projected to hit at least 7 million tons this year with upside potential. Their potash operations are benefiting from the completed K3 mine shaft at Esterhazy, which eliminated historical flooding issues and is driving down unit costs. And their Mosaic Biosciences division, a higher-margin specialty business, doubled its net sales to $68 million in 2025 and is expected to double again in 2026. But here is the catalyst that really caught my attention as a veteran portfolio manager. Mosaic just entered a joint project development agreement with Rainbow Rare Earths to advance the Uberaba Rare Earths project in Minas Gerais, Brazil. They are planning to process approximately 2.7 million tons per year of phosphogypsum, which is a byproduct of their existing fertilizer production, to extract rare earth elements like neodymium and praseodymium. These are the exact materials used in electric vehicle motors, wind turbines, fighter jets, and advanced technology hardware. They are also targeting production of medium and heavy rare earth elements. Construction could begin as early as 2027, with production targeted for 2030. Now, in a world where China controls over 90% of global rare earth processing and has been weaponizing export restrictions, any Western company that can develop domestic or allied rare earth supply is positioned to receive enormous government support and strategic premium valuations. Mosaic is essentially taking a waste product from its existing operations and turning it into a potential revenue stream tied to one of the most strategically important commodities on the planet. At the current price, around $28 to $29 per share, Mosaic trades at a price-to-book ratio of roughly 0.81 compared to the sector median of 2.49. The PE ratio is about 17, the dividend yield is approximately 3%, and the company has maintained that dividend for 16 consecutive years. The average analyst price target is around $32 to $34, with some estimates reaching $40, representing meaningful upside from current levels. And if the Strait of Hormuz disruption persists, which military and geopolitical analysts suggest could last for months, fertilizer prices could remain elevated well into the planting season, creating a powerful tailwind for Mosaic's revenue and margins. Now, the risks are real, and I'm going to be honest with you, because that is what separates this channel from the noise. Mosaic's Q4 earnings were a significant miss. Cash flow generation in 2025 was weak. Net debt increased substantially. High sulfur prices are expected to compress margins in the phosphate segment through the first half of 2026. There is also a Department of Justice investigation into potential fertilizer price coordination that creates regulatory uncertainty. And the rare earths project is years away from generating any revenue, so do not treat it as a near-term catalyst. But as I always told my clients at the institutional level, the time to buy commodity producers is when the news is ugly, when the balance sheet is stressed, and when a catalyst exists that the market has not fully priced in. The Strait of Hormuz disruption combined with improving operational efficiency and the rare earths optionality create exactly that kind of setup. Now let me be crystal clear about something because I built my career on this principle. I am not telling you to go all in on either of these names. At JP Morgan, we never put a disproportionate amount of a client's wealth into any single position. Every stock I discuss on this channel is meant to be part of a diversified portfolio, sized appropriately for your risk tolerance and financial situation. Scalar is a high-growth technology company with meaningful volatility. Mosaic is a cyclical commodity producer exposed to geopolitical events and agricultural pricing. Both carry risk. Both could go lower before they go higher. But both represent, in my professional assessment, the kind of quality businesses that institutional investors accumulate during periods of maximum pessimism. That is the playbook that built generational wealth for the families I served for 4 decades, and it is the same playbook I am sharing with you right now. So here is what I want you to do. I want you to think about this. In 5 years, do you believe the world will need more cybersecurity or less? In 5 years, do you believe 9 billion people will need more food or less? If the answer to both of those questions is more, then the question is not whether Scalar and Mosaic are good companies. The question is whether you had the discipline to buy them when everyone else was afraid. That is the difference between spectators and wealth builders. That is the difference between hoping for a better financial future and actually creating one. If this analysis helped you see something you were not seeing before, I need you to do 3 things for me. First, smash that like button so this video reaches more people who need this information. Second, subscribe to Invest with Marcus and turn on notifications because the next opportunity could come at any moment and I do not want you to miss it. Third, drop a comment below and tell me which stock you think has more upside in 2026, Scalar or Mosaic. I read every single comment and your insights help shape future content. Share this video with someone in your circle who is serious about building wealth, not chasing hype. This is Invest with Marcus, and I will see you in the next one. Stay disciplined, stay informed, and remember, the market rewards patience and punishes emotion. Let us build this legacy together.